Assalamu alaikum wa rahmatullahi wa barakatuh. Good afternoon, everyone. My name is Nasser Sanousi, Senior Director of Marketing and Corporate Communications at Bورصة. Thank you for joining us today. At the exchange, we truly believe that strong market relies on education. It's why we focus on supporting everyone in the investment community. We recently launched our new fixed income platform, which is a big step forward, but launching the platform is only the first step. The real value comes from ensuring everyone feels comfortable navigating it, which is why we're here with our partners at the CFA Institute and the CFA Society Kuwait. Today, we look how bonds and sukuk are priced, how to read yield curves, and how to manage risks. Thanks to the CFA teams for helping us make this education accessible. I hope you walk away with clear practical insights you can use immediately. Mr. Anish, the floor is yours. Thank you.
Thank you, Mr. Nasser, for such a brief introduction. My name is Ashish Shetty. I'm a board member at CFA Society Kuwait. Good afternoon, everyone, once again. On behalf of CFA Society Kuwait, it's my pleasure to welcome you all for today's webinar on ETFs and fixed income investing, organized in collaboration with Bورصة Kuwait and CFA Institute. We are delighted to see such a strong participation from finance professionals, investment practitioners, students, and members of the broader investment community. Today's session reflects our shared commitment on advancing investment knowledge, promoting professional excellency, and fostering informed decision-making across capital markets. I would like to extend our sincere appreciation to Bورصة Kuwait and CFA Institute for their continued partnership and support in delivering high-quality education initiatives that contribute meaningfully to the development of the investment professions. This webinar provides an invaluable platform for knowledge sharing, professional development, and engagement with global industry experts. We are particularly honored to be joined today by Mr. Rob Lamner. We are grateful for his time and willingness to share his insights on the evolving landscapes of ETFs and fixed income investing. As investor navigates increasingly complex and dynamic markets, understanding the ETFs and fixed income instruments in the portfolio construction, risk management, and long-term wealth creation has become very important. Once again, so thank you for all joining. I look forward for the engagement session. With this, it's my pleasure to hand over to Michelle. Over to you, Michelle.
Thank you, Ashish, and thank you, Mr. Nasser, for the introduction. Thank you, everyone, for joining today. My name is Michel Botrus. I am the Global Partnerships and Client Solution Manager for the MENA region for CFA Institute. And today we are joined by my colleague, Rob Langrick, CFA CIPM, who is the Chief Product Advocate for CFA Institute based out of the New York office. He was previously the General Manager for the CFA program, and before that, Head of Practice Analysis, overseeing the annual curriculum updates to the CFA program. Hopefully, you'll find this session very informative and to your liking. Over to you, Rob.
Very good. Well, thank you for the lovely introductions. It's a real pleasure to be here today talking about the world's biggest market, which is the global fixed income market. So before I dive in, I'll just give us a sense of scale. So the world fixed income market's well over $100 trillion. So it's significantly bigger than even the global equity market. When we look at ETFs, that's around a $20 trillion market. So the big difference between fixed income and ETFs is fixed income is much bigger than ETFs, but ETFs is growing much faster. So last year in the USA alone, it grew close to 30%, the actual size of the ETF market. So it's definitely one to watch. We're now seeing the two come together. We're seeing fixed income ETF products come about more and more so. So we're seeing the two worlds collide. So you may say, well, what is driving the fixed income market and the ETF market? Quite simply, the fixed income market is driven by government borrowing. So governments around the world are borrowing ever increasing amounts to finance their government their deficits, and with that, you're going to see more and more growth in the fixed income market. ETF market is a different growth driver. So it's really become the default way in which people invest, in particular in the equity markets today. So it's a much more convenient wrapper than mutual funds. So it's definitely become the kind of main growth driver for the financial market income today. So I think I was asked to talk about what we teach you about fixed income in the CFA program. So I'm going to give you a quick guided tour. And what I'll do, I'll use the Bloomberg terminal as a way to kind of showcase that. So I'm going to experiment, and Michelle will let me know if this works or not. Maybe doing a half screen PowerPoint, half screen Bloomberg, and then we'll kind of go in. So let me share my screen and get that set up here. So if I share my screen here and show Bloomberg for one half, Michelle, you'll have to keep me honest, Michelle, if this is working or not. Michelle, can we now see the PowerPoint and the Bloomberg screen?
Yes, I can see half of the screen is Bloomberg and half of the screen is your PowerPoint.
Very good. I'm actually going to change this very quickly to reduce the size of the font on Bloomberg to make it more visible. So give me 1 second while I do this. Here we go. So the equity market is how young people first tend to encounter the financial markets. So there's a new language you have to learn, essentially fixed income. So first of all, why should your teams learn fixed income? Why should young people focus on fixed income? Let me give you a few reasons. So first of all, it's the biggest market in the world. The second reason is there's lots of issuance of fixed income instruments, including in the GCC countries, the Gulf region. So there's a lot of big construction projects. There are lots of bond issuance. There's green bonds as well, with the rollout of data centers and renewable energy. We also see sovereign wealth funds decoupling from the oil markets by fixed income investing, getting ballast in the portfolio, and risk management. It gets more and more important to manage risks the more fixed income you have in the portfolio. So these are the key reasons why young people should learn fixed income. And what's interesting, when you look at the fixed income market, it is indeed the biggest market in the world. So more than half of the world financial markets are fixed income. We're looking here, more than half. And of that, it's a mix between lots of countries, but especially USA, European Union. And of the USA in particular, US Treasuries is half of that. So US Treasuries is really the kind of heart of the financial markets. And we'll be talking about that for a few minutes here. Sovereign wealth funds, though, are very important in the Gulf region. So if we look at the jobs that CFA charter holders do across the main Middle East and North Africa countries, you'll see that sovereign wealth funds are very important, part of it. So Kuwait Investment Authority, for example, or Qatar Investment Authority, Oman Investment Authority, Abu Dhabi Investment Authority, Public Investment Funds, Saudi Arabia. So sovereign wealth funds are a very important part of financial markets in the Gulf region. And what's really interesting about that is often they have large fixed income portfolios. When we look at the actual returns you can expect on a sovereign wealth fund, oil typically does not have very good returns in the financial markets. But diversified sovereign wealth funds typically can expect 7 to 9% returns, and they diversify often with a fixed income exposure. So it's a very important way to diversify away from fossil fuels, is to add fixed income to the portfolios. And if we look at the sovereign wealth fund fixed income portion, you'll see that they're double digit across different sovereign wealth funds globally. So fixed income is a very important part of sovereign wealth fund exposure. Another reason why young people need to learn about fixed income is the ballast of sovereign wealth funds. Okay, so let's look at the CFA program quickly. So we teach you all the different asset classes. So you learn about equities indeed. You'll learn about derivatives. You'll learn about alternatives, but you'll learn about fixed income down here. And so for many people, this is the main way to learn fixed income is through the CFA program. It's a really important asset class, and it's often the way people learn fixed income. So if we look at the CFA program here, the stack of books, fixed income book is here for BOSI. It's the main fixed income book. And I asked a question in a survey not long ago, where did you learn about the bond market? And most people say a credential like the CFA program or the Fabozzi book here, fixed income book. So the CFA program is the world's #1 place you come and learn about fixed income. Okay, so let's have a look at the curriculum quickly. Across 10 topic areas, fixed income is 11, quite a big part of the curriculum. And if we look at what people find hard, however, candidates find fixed income one of the hardest topic areas. So here's the difficulty level across the topic areas. You see fixed income at level 1, level 2. People find it quite hard along with derivatives and accounting. So it's quite a difficult area for young people, fixed income. And when we look at the pass rates of the CFA program, around 50% down here, a key reason why the pass rates are around 50% is the mathematics component of fixed income and derivatives in particular. So very important to get the fixed income right. And when we look at the CFA program, this is across level 1. We look at level 1 of the fixed income of the CFA program here, you'll see it's got a very high mathematical level. So fixed income is very mathematical when we look across the different areas we teach you about fixed income. And if we go to level 2 and level 3, so you've got 500 pages learning in level 1. If we look at level 2, level 3, about another 500 pages of learning here, level 2, level 3, and you'll see that the mathematics level is very high when you get to level 2, level 3. So fixed income is very mathematical. So I'll just say that before we dive in here. So let's dive in and actually look at the different areas. I recognize this font is small, but I'm going to be focused on the Bloomberg terminal now. Let's talk about the first part, types of fixed income securities. So the fixed income market is very diverse. And on the Bloomberg terminal, if we go to search or fixed income search here, you can see all the different types of fixed income instruments that are available. There are 3.8 million fixed income instruments here, and there are lots of different ways in which you can slice and dice the fixed income market when you come to fields. You can have different ownership, different pricing, different risk measures, and so on. Different companies issuing bonds, your ESG bonds, and so on. Lots of different types of fixed income instruments for a total of about 4 million fixed income instruments of lots of different types. So we teach you about the different types of bonds in the market to begin with. Then we teach you about fundamental fixed income analysis. So things like yield curves, for example. So if we graph the curve, if we graph curves, the main way to look at yield curves is GC on the Bloomberg. Here is the actual USA yield curve with tenors from 1 month through to 30 years. You'll see it sloping upwards here. And on the y-axis is the yield to maturity at different points along the curve. So this is where you do fixed income fundamental analysis. You look at the yield curve, which can be different compared to governments, compared to companies, and so on. So it can be very different. We can also look across the bond market, the world bond market here, WB, world bond markets, world bond markets here, WB. You'll see there are lots of different countries you can look at with different yields. So when we look at the 10-year yields, USA at 4.5, Canada 3.5, Brazil 6%, Argentina 9%, and so on. So there are lots of different yield curves you can look at. And this is where you start your fixed income fundamental analysis, is looking at yield curves. Now, let's talk about term structure. So here's a yield of a 10-year bond. But notice if we say look at the 30-year bond here, it goes to 5%. It changes when we change the actual tenor. It's called 5-year yield 4.2%. We look at the 2-year tenor 4.1%. What you can do, you can look at this in 3 dimensions. So if I do GC3D, you can look at the yield curve in 3 dimensions by saying, I don't just want to look at the curve through time on the green curve we saw earlier. I want to see it depicted through time. So here you can see a yield curve with the actual date on the x-axis here. And actually, I can change it and say, no, I want to go a bit further back in time to 2025, for example. And what the cool thing about this chart is not just looking at a flat curve here, you're now looking at the yield curve through time on this axis, as we'll see in a second. And so I'm going to call out a couple of things. So this is a really important way to visualize the bond market and understand how the term structure is determined, because the term structure changes through time, as you can see on the three-dimensional chart. So when you realize the curve is steepening and flattening at different points in time, that's when you realize the financial market is changing the shape of the yield curve through different factors. So for instance, here we're looking at US Treasury actives. You can see the long end here, the 30-year mark's gone up recently with inflation coming from primarily from geopolitics. The short end used to be high, then it went down low as rates were cut. And maybe we'll see rates going up on the short end in the short term here. But this is a great way to visualize the term structure and see it changing through time by looking at the yield curve with the time on the x-axis there. Okay, let's talk about valuation of individual bonds. So if I come and look at an individual bond and type in and go to yield to maturity, I go yield and spread. It's called the yield and spread function. If you pull a certain bond, let's take this bond here. And I'm now saying I want to look at the yield and spread. You can look at single bonds and say, you know, I want to know what's the yield on that bond. So this bond is 5%, the bond we've got loaded here, by the way. And so this is the main way people will actually price a bond, is looking at the yield. And you can change it and say, no, I want the yield to worst. You'll say, no, I want the yield to maturity, which actually takes into account, it's a different way to look at yield, is looking at yield to maturity. So you can look at lots of different bonds. I can look at a Vodafone bond, for instance. So you have Vodafone bonds, the telecom company, and you can pull up different bonds and see the yield. The yield in this case is 6% on that bond. That's the main way people look at the valuation of individual bonds, is looking at the yield. Now, if we look at interest rate risk, you'll see that actually people now spend a lot of time looking at what the federal fund is the central banks are doing with yields. So if I look at the overnight lending rate or world interest probability, people spend a lot of time trying to predict the what the central bank interest rates will be over time. So here, for instance, we're looking at the probability, the implied overnight rate in terms of fixed income through time. People spend a lot of time looking at percent chance of a change in the interest rate. So for example, there's a 3% chance of a hike at the 17th of June meeting. But when we come to the 16th of September meeting, there's a 32% chance the Federal Reserve will lift the interest rate according to financial markets. This is called interest rate risk, the risk that the central bank will lift interest rates. So people now do predict that interest rates are going to go up, and that creates interest rate risk, because when interest rates go up, bond prices tend to go down. So now let's have a look at credit risk. So each individual bond has different credit risks, and you can look at credit ratings for companies. So when I look at a company, the credit profile of, I can look at credit profile of a company. So Vodafone has a certain credit profile, Baa2 is the rating on Vodafone, for instance. But if I look at governments, they also have credit ratings at credit risk. What's the chance that government doesn't pay back its fixed income? So if I come at World Countries Debt Monitor here, WCDM, you can actually then pull a column saying, I want to see actually what the different ratings are here. So we can see that which country has the highest rating in the world. I can sort it. The highest ratings here, you can see the country with high ratings, or you can sort with lower ratings as well. So Switzerland's got a very high rating, for instance, of Japan, Singapore, USA, and so on. And so you can actually, countries also have credit ratings linked to their bonds, their likelihood, their willingness and ability to repay. Now, some bonds can have embedded options as well. So it's not just the government bonds tend to be fairly straightforward, but you often are valuing bonds with embedded options, which is when you look at the yield and spread we saw earlier, or YAS, yield and spread. This is what it means when you have yield to maturity or yield to worst or yield to next call. What does that mean? So when a bond can be repaid before maturity, you're going to want to look at different yield measures because they're going to have different yields based on those repayment features embedded in them. So structured products is quite a new area of the market where you've got things like mortgage loans or asset-backed securities. And that's quite a big part of the fixed income universe, where it's not just straightforward governments borrowing money for a long time, although that's the biggest part of the bond market. There are also what are called structured products. So finally, fixed income portfolio management. So often insurance companies put a lot of their portfolio into bonds. And if you come to the portfolio tool on Bloomberg, you can actually run a portfolio. You can look at a portfolio not just of equities, but a fixed income portfolio. That'll take a while to come up, but I'll show you how money managers manage fixed income portfolios by showing the performance and running attributions. They do it differently than an equity portfolio. And in the port tool on Bloomberg, it's where you'll run a fixed income portfolio and look at various risk measures looking at that portfolio. That'll pull up in the background now. I may come back to that once that has loaded. And while that's loading, I'll have a quick quiz. I'll show an example of the CFA exam in fixed income. So here's a question for you. This is a sample level 1 fixed income question from the CFA exam. So here's the question. Modified duration is the most appropriate measure of interest rate risk for which of the following? So a callable bond, a US Treasury bond, or a mortgage-backed bond. So modified duration is most appropriate for which. Have a think about that. While I tell you this question, the reason I'm showing this to you, this is a classic CFA exam question. Notice it's got it's a very short question. Notice the answer choices are very short, but also notice if you've not read those books I showed a bit earlier, you'll not be able to answer this question. You'll only have a 33% chance of getting this question correct. Now, to answer the question, modified duration is, of course, used for US Treasury bonds only. And the reason for that, they don't contain prepayment features. So a callable bond and a mortgage-backed bond are prepayable. A US Treasury bond is not prepayable. You can only do modified duration on a bond that is what we call vanilla, but it doesn't have these prepayment features. And that's why the correct answer to this question is B. A great example of how you learn the technicalities of different measures in the fixed income market through the CFA program. So I think the Bloomberg's maybe not behaving very well in terms of pulling up that attribution report to show how portfolio managers manage the portfolio. Suffice to say, it's very different from the way a portfolio manager manages an equity portfolio. So if you're running an insurance company, for example, tend to have very long-term liabilities, and you'll do what's called immunize the portfolio to meet long-term liabilities, be it for life insurance or property and casualty insurance. That's fairly predictable. The actual payments are fairly predictable. So it's a very different way to manage a portfolio than from managing an equity portfolio when you're buying things like Nvidia or Tesla and so on. Okay, so that's kind of the guided tour. So I'm going to come off sharing the Bloomberg now, turn my video back on here. So now we've spent half an hour talking about the actual fixed income markets and the main things we teach you about fixed income in the CFA program, the types of bonds, the term structure of interest rates, three-dimensional yield curve, looking at interest rate risk that central banks lift interest rates, credit risk that companies or governments won't repay, and then we're looking at prepayment features which make the universe more complicated. And finally, we looked at fixed income portfolio management, how it is that people manage a fixed income portfolio very differently. But I'm going to go back to the very beginning. It's very important to learn fixed income. It's the biggest market in the world. There's booming government borrowing, and especially for the Gulf region, it's a strongly growing area of the markets, especially with the sovereign wealth funds looking to diversify their portfolios in particular as they transition their economies in terms of diversifying the industry mix. It's very important to have that fixed income ballast in the portfolio to diversify the income streams available for each of the different countries. So that's my introduction to fixed income through the prism of the Bloomberg terminal. Happy to answer any and all questions you may have.
Thank you, Rob. I think that was a very comprehensive session. Don't you agree, Ashish?
I absolutely agree. It was very insightful, giving you crux of what CFA Institute teaches you in terms of fixed income, how it can be applied to real life, and how to go through and screen your universe of around 4 million, what was mentioned by Rob, and go through detailing of each of the universe and look at the fixed income. So it was incredible from my perspective too.
In terms of questions, if anyone has any questions, please feel free to add them in the chat, or if you're brave enough, just unmute yourself for this part of the Q&A and ask it directly to Rob. As he mentioned, he'll be happy to answer any and all questions you may have related to this topic. To break kind of the ice, and I'll start with one that might be on some of the audience that is mind. The shortcuts, Rob, that you just used to navigate the Bloomberg terminal, are those also included part of the CFA program? So if one takes the CFA program, will he learn some of the shortcuts or all of the shortcuts you have shown us today?
Yes, actually. So we've now put the Bloomberg, those functions that I was showing on Bloomberg inside the CFA program. So when you're studying the digital curriculum of the CFA program, when we teach you the different parts of fixed income, we teach you the Bloomberg functions that I showed. So you learn that when you're going through the CFA program. Now, we don't test on Bloomberg terminal functions in the CFA exam. So it's purely just to help you learn how to use the world's #1 data platform. But what I can tell you is when you look at all the sovereign wealth funds in the Middle East, KIA, for example, but also the large money managers, they all have Bloomberg terminals. They tend to be shared on the floor. And so you can walk up to it and use the Bloomberg to pull data. And it's a very powerful thing to learn because it's where you're going to get the data from to write your reports. So yes, we do teach you about the basics of the Bloomberg, all the things I showed you. We teach you that in the CFA program as you go through all of level 1, level 2, and level 3. So all the way through the CFA program, we teach you Bloomberg.
I believe so. I guess there is one question coming from the chat box that says, what is the difference between bond and sukuk?
Yes, of course. So sukuk is a subset of the global fixed income market. It's increasing in popularity. So it's bonds that have been approved for investment usage in Islamic finance. And it's a growing part of the investment market, not just in the Gulf region, also places like Malaysia and Indonesia. So it's essentially, it's bonds, part of the Islamic finance universe. So it's a subset of the global fixed income market.
Thank you, Ahmed, for the question. I hope it has addressed. One question from me, I hope it helps audience as well. What segment of the bond market currently offers the most attractive risk-adjusted return, Rob?
So, I mean, the credit analysts and investment strategists are paid a lot of money to answer that question. So that all depends on your point of view about the yield curve, about inflation in particular, about growth, about the output gap, about economic indicators. So it depends on your point of view. And of course, you're going to be constructing a portfolio. So I don't know what are the risks you're trying to offset in your portfolio. When we look at do you remember that 3-dimensional curve I showed you? The long end's going up, becoming red, which means yields have been rising. So if you buy a long-term bond and hold it to maturity, you now get a higher yield than before, given that lift in rates. Now, what we saw in like 1980, though, those interest rates can go up to 20%. which means the prices will go down. So just because rates are high doesn't necessarily mean it's more attractive. So it's very hard to answer that question because it links to the macroeconomy, and that's very hard to predict where we are in the cycle at any point. Interest rates are going up. I think the Federal Reserve will start lifting interest rates. We saw that the percent probability in September is the Fed lifts interest rates, they go up, which actually will send short-term bond yields down. So it's very hard to answer that question. And it also links to creditworthiness of the issuer itself as well. So bonds can be rich or cheap, meaning when you look at fundamental valuation, people can think they have an attractive price or unattractive price. But that you should ask a credit analyst that question.
Right. Again, another popular question that happens to be, right, how we have a lot of ETFs available through indexes, right? Do we have similar on fixed income, like to get an exposure? Basically, as you rightly pointed out, you need an expertise to understand fixed income. It's not as straightforward as comparative equities. So you need to have that mindfulness of what's happening on the interest rate, the macro perspective, the inflation of that particular country, a lot of parameters, right? The FX impact kind of stuff. So are there any popular ETFs where you have like safer exposure? You know, it's going to be there. You just track it. Simple explanation. What's your thought process?
Yes, there are fixed income ETFs. Probably the most popular fixed income ETF in the world is the TILT, TLT, which is Treasury Long-Term ETF, TLT. That people often use as a very convenient way to trade the long end of the yield curve. So fixed income ETFs is growing. It's less developed than equity ETFs. It's harder to index the fixed income markets because remember, there are 3.8 million bonds. There are far more bonds than there are equities. So when you index it, you sample. So the main index is called the Bloomberg Barclays Aggregate Index. There are ETFs that enable you to sample the whole bond market, but it's not like buying an S&P 500 tracker, which does buy the whole S&P 500 equity market, by the way. It's different. It's becoming more popular to have fixed income ETFs these days.
All right. Anyone from the audience have any couple of questions we look forward to address? Okay. There's one new one. Mentioned that okay, I'm going to repeat the question for your reference, Rob. It was mentioned that far more fixed income than the equity trades. Is that the same in the Middle Eastern region? If not, do we expect that to grow in the near future?
So we do expect it to grow in the near future. Let's take, for example, the transformation happening across economies in the Gulf region. Saudi Arabia is a really good example because it's a very large economy. And there's a lot of transformation taking place with geothermal energy, green energy, data centers. There are lots of new industries that the Saudi government is financing, for example, and a lot of it is financed with fixed income. So you do see a lot of fixed income issuance. Saudi Arabia is now the world's #2 issuer of government bonds. So you do see growing fixed income activity in the Middle East. Classically, you've had lots of stock markets growing in the Middle East with Tadawul in Saudi Arabia, for example, and the IPOs like Saudi Aramco several years ago did an IPO, largest IPO in the world. It will be until SpaceX coming up right now, maybe. But yes, fixed income is becoming more important. Remember what I said at the very start, the thing driving fixed income is government borrowing. And you're going to see more and more government borrowing, not just in the Gulf region, but also globally. But yes, it's true. There is more government borrowing happening in the Gulf region. And for that reason, fixed income is going to grow faster than the equity market.
Amazing. That was really insightful. Any more questions from the crowd? Okay, all right. Seems to be the audience seems to be proactive and understands every nuances of the fixed income. It's good to see how creative the participants are and having an experience and expertise. From my end, I've ended my questions too. Michelle, if you have any questions to add, we're happy to take in. Otherwise,
I think one question maybe to end maybe the session, Rob, is maybe are you able to give the audience kind of a framework or an idea about who takes the CFA program? Because we're focused now on fixed income and fixed income analysts and people that want to invest in fixed income, know more about fixed income. Could you let them know if their line of expertise, would they benefit with taking the CFA program or not? Should they pursue other certificates? And I see in the meantime, we also have another question that follows mine on the chat.
Yeah, there are lots of job roles. I think there are 54 job roles that people do with CFA programs. So portfolio manager, credit analyst, risk analyst, compliance, hedge fund manager, investment consultant, investment banker, private equity, blah, blah, blah. So there are a lot of different jobs people do. The number one job role when people start the CFA program is the big four accounting firms, KPMG, Deloitte, and so on, PricewaterhouseCoopers. But that's only 7%. So there are plenty of people in commercial banking who do credit analysis, lending, who start a CFA program. So there are lots of different job roles available for people. There's a question here, how does the Kuwaiti market develop in ETF? When we look around the world, ETF is growing relative to everything else. So it's, as I mentioned at the start, it's growing at almost 30%. The ETF market year on year is booming, although it's much smaller than the fixed income market. So people say, with AI, they're worried won't be jobs for young people. My answer to that is go and get a job in ETFs. So ETFs is growing so strongly, and it's such an important part of private wealth management and retail finance. There are plenty of jobs doing anything to do with ETFs, ETF research, ETF strategy, private wealth, brokerage, and so on. So ETF is a really good place to build your career, and it's getting more and more kind of relatively important. I think, did I answer your question, Michelle?
Yeah, you answered it perfectly. I think we have one more question in the chat. Ashish?
Yes, and then we should be good, I believe so. How are the structured products are still in use, especially after what has happened in financial market in 2008? What I can give in reference is we have been very active users. I represent a family office. We have been very active users of structured products on the equity side. But on the fixed income side, what's your take, Len? And what happened through financial crisis? How do we take?
Yes, I remember very clearly 2008 when there were structured products with lots of insolvencies, and there's what's called the credit crunch when there was a big downward move in the financial markets given the excessive borrowing. We do still see some of those instruments, but now people are better at risk management, I would say. Jamie Dimon, the CEO of JP Morgan, was saying over the weekend that be wary of credit spreads right now. So he definitely sees some risk in terms of some lending that's happened. But yeah, structured products, the issue in 2008 was the banking sector. So the banking sector was overextended. And so that was it was a banking crisis, given the excessive subprime mortgage lending. So people borrowing money to buy a house when they had no money, basically. So that's been cleaned up a lot with the so-called Basel II and Basel III banking standards, where banks now have to hold more capital. And so that's less of a risk than it was in 2008. So I don't think the next financial crisis will be like the last financial crisis. It'll be something different. I don't know what it will be. But the good news is right now we have the AI boom, which is really helping the world stay growing quite simply. Given the geopolitical situation, the AI boom is really quite precious. This is why we see so much investment in AI and data centers in the Gulf in particular. It's one of the leading areas for AI investment, which is good because it offsets the weakness elsewhere, and obviously with the high oil price, which is causing consumer inflation, which is a problem.
Rob, I believe so. As the conversation getting exciting, the people in the seminar are getting more excited. So there is one more last one, I believe, so we can take up. When we mentioned of the fixed income is the largest market, which of its government is in government bonds? Like, what's the size, what they're looking basically?
Well, you got private credit is $1.7 trillion, but government bonds it is tens of trillions of dollars. So the government bond is the biggest part. The second biggest part is called investment grade debt. That's about $13 trillion. And then you got much smaller things, leverage loans, 1.7 trillion as well. High yields, $1.7 trillion. So you got much smaller parts there. Mortgage-backed securities, a few $1 trillion. Municipal bonds, about $4 trillion. But the biggest bit is government bonds. And I think that will remain the case because governments borrow so much money around the world, all around the world. So Japan has got the highest debt load of any single country relative to GDP, for example. So government bonds is the biggest part. And I think it will remain the biggest part.
One final question, Rob, and then I guess, Michelle, we are good. Can we still rely on the debt rating agencies, Rob? What's your take on that?
Well, I think that's a reference to the fact the credit rating agencies did not save us in 2008. So 18 years ago, the credit rating agencies were kind of asleep at the wheel, as it were, which is a problem. So they definitely tightened their practices from back then. But I don't think you can rely alone on credit rating agencies to protect the portfolio manager. You have to do the credit research yourself. You have to ask about the ability to repay a loan, the willingness to repay a loan, no matter which segment you're talking about. So I don't think you can just rely on a credit rating agency to tell you not to lend money to somebody.
Perfect. Thank you, Rob. It was really very insightful. There's something to look for, and I personally also have some few takeaways on bond markets and the ETF. Michelle, over to you.
Thank you, Ashish, and thank you, Rob. I think it was concur with Ashish. It was a very, very insightful session for myself as well. And hopefully to everyone who participated today. I want to thank everyone for taking the time and joining us today. Hopefully you've learned as much as I did, and we'll be waiting to see you next time. Thank you, everyone.
Thank you.
Cool.